Good morning, good afternoon, and good evening, wherever you may be, and welcome to this webinar organized by Fintelekt and Asian Bankers Association again this month. My name is Shirish Pathak. I work at Fintelekt, and it is my pleasure to be a host again today for this webinar. My sincere thanks to our dear friends at the Asian Bankers Association, Ernest Lin, Amador Henrado, and Mig Moreno, for their ongoing efforts in organizing educational sessions like this for the benefit of the Asian compliance community. So the title of today's webinar is Future-Proofing Your Financial Crime Compliance Screening. The current regulation and compliance frameworks designed to combat crime pose a challenge that may slow down customer onboarding while increasing false alerts and operational costs, therefore having a negative impact on the customer experience. We are also witnessing a rapidly changing sanctions landscape along with its accompanying challenges. At the same time, the cost of compliance is increasing, as most of you working in the banking financial services industry know. Today, we will try to cover a few different elements in the webinar, starting with a presentation on the total cost of compliance and its impact on various aspects within the MLCFT framework, including but not limited to screening, due diligence of customers, TBML, eKYC, and overall paradigm shift in identity matching. We will then move on to a panel discussion on related matters, including trade and payment screening and best practices that compliance officers may take note of. Before we begin, let me introduce our speakers for today. We have with us Srinivas Vaman, Joint President and Business Head, Trade Finance and Commercial Operations at Kotak Mahindra Bank, who is based in India. Vaman is a seasoned banking professional with more than 25 years of experience and specializes in the domain of trade finance. In his current role, he is responsible for the front-end customer service delivery and transaction processing. He believes that the job entails a very fine balance between the needs of the client and the contours of risk and regulatory compliance. Vaman, welcome and thanks for joining us today.
Thanks, Shirish. Thank you.
Our next speaker is Brent Estrella, Group Chief Compliance Officer at Rizal Commercial Banking Corporation, based in Manila in the Philippines. Brent took over this role in December 2020, prior to which he has more than 16 years of compliance and risk management experience, which he gained from the Hong Kong and Shanghai Banking Corporation across various jurisdictions in Southeast Asia, the Middle East, and Sub-Saharan Africa. Brent, welcome and thank you so much for joining us.
Thank you for having me here as well.
And our third speaker today is Douglas Wolfson, Director Market Planning, FCC and Payments at LexisNexis Risk Solutions, who's based in Hong Kong. Doug is a risk management specialist with 20 plus years experience in global financial markets and has been responsible for compliance, credit, and operational risk with international experience developed in institutions across New York, London, and Hong Kong. His experience spans compliance, credit, and operational risk, IT and cybersecurity risk, amongst other subjects. Douglas, welcome, and great to have you here with us today.
Thank you very much. Great to be here.
Great. So welcome to all the speakers. Welcome to all the attendees. We've got a great turnout today again. To start with, Douglas, may I request you to start off your presentation?
Absolutely. Please just let me bring up the PowerPoint.
Sure.
Fantastic. Well, thank you, Shirish, and thank you to our other panelists, Vaman and Brent, for joining me today. I think this is a really interesting subject, speaking about the future of financial crime compliance, because it is a rapidly evolving space, as Shirish mentioned, and it's really important that we look at how we as professionals in the space, and I was in the risk management space, part of which was with FCC responsibilities prior to joining LexisNexis Risk Solutions. How do we keep up with the changing times? How do we keep up with more and more sophisticated criminals and more demanding regulators? And a large part of that comes down to cost and our ability to cope with the increasing costs that come with more and more screening obligations and more requirements placed upon us. So what I want to present to you is a recent survey that we've done at LexisNexis Risk Solution called the True Cost of Compliance. This is the third year running we've had this survey, and so some really interesting data that we've been able to gather from it. Now, first, before I get into the data, just a little bit about the purpose of it and how the survey was conducted. Essentially, the key focus for us was understanding the cost of financial crime compliance. How is that money spent? Is it spent on technology? Is it spent on labor? Which aspects of financial crime compliance are companies spending the most money on? And where and how is that being developed? Also, we tried to look at the time for processing, screening, alert remediation, transaction monitoring, how long it takes in the current environment versus previous years to deal with all of these various issues that we deal with. How does that timing work in terms of past years? And obviously, there's one big storm that sort of hangs over the entire financial crime compliance space, and quite frankly, over business and over all of our lives, and it's COVID. We haven't been able to avoid it for the past year, 15 months or so, depending on where you live. And it was important for us to obviously look at the pandemic and how that drove costs over the course of the past year. Now, what is really key for us here is to explain to you how this survey was done. We retained a third-party global market research firm to do this, and it was done essentially double-blind, not in the medical sense, but it was done without us knowing who the respondents were and without the respondents knowing that they were doing it for LexisNexis Risk Solution. This would ensure that the answers wouldn't be skewed because obviously we're a player in that market. And we want this to be honest answers to an honest survey without any possibility of this being tainted by the fact that we're in the technology business and we're in the financial crime compliance technology business specifically. We looked at small companies, less than $10 billion versus large companies, the large banks that a lot of you would know in a lot of markets, a lot of large asset managers, insurance companies. And we looked at third-party and non-bank payment providers. However, we didn't look at them directly. We didn't speak to them. We spoke about them to the banks to see what their effect, what the payment providers and the DNFPVs, what their impact on the financial crime compliance space is. So first of all, key findings. Look, I think no surprise, we see it year after year after year. The cost of financial crime compliance has risen significantly in 2020 versus 2019. And this is before we even started to look at COVID and the effects of COVID. There was a significant increase already. The key challenge that banks are facing, KYC for account onboarding, remains the key challenge for banks. COVID-19 has obviously affected financial crime compliance operations and spends for obvious reasons. Working from home it's significantly more difficult to gather together to get answers. I can't just turn to the person sitting next to me. I have to get time with somebody, get them on the phone, send them an email, wait for a response. But also not so expected answers. A lot of online companies saw a significant increase in their online enrollment. And so this creates a backlog for screening for customers. We found that again, and we found this most years, that financial crime compliance activities do provide benefits, and we're going to talk about those a bit. And that most importantly, financial institutions that have invested in technology have lower costs per FTE, have greater economies of scale because of that technology. And it might seem like fairly, accepted wisdom, common sense that more technology using RPA, using AI and ML, this would allow for more, less manual labor, more repetitive costs being done quickly. but we're going to go into a bit how much that cost savings is because it's quite astounding. So if we start with key finding number one, the cost of financial crime compliance. I think this is the slide that journalists love to see. This is always the first slide we have to present because we call it the true cost of compliance. We feel the obligation to let you know what that cost is. And we roughly estimate it at around $12 billion for the APAC financial firms in the region. However, I would say take this with a grain of salt because at the end of the day, that number is in a bit of a vacuum. It as itself is somewhat meaningless. What becomes important is how much companies are spending themselves, how much the increase is from previous years, and why those increases are happening. More important, we think, is this split here between technology and labor. And as you can sort of see here, a little bit over half, maybe 5 to 10% over half of the spend is on labor, and we've seen that uptick. My personal belief is that that's largely because of COVID, that there was a quick need to go out and hire a lot of people to deal with an influx of new customers and an influx of new screening risks that came up. However, it is an increase from what we've seen in the past year, which was around 50 to 55% was labor. What we see here is that distribution, a fairly even distribution of costs between the various activities that a compliance department undertakes. And as you can see, it's roughly the same. That split is roughly the same for both large and small companies. So sort of no major surprises between the two there. It's all very understandable. So when we look at the various activities that a financial crime compliance department undertakes, as you just saw, KYC for account onboarding was taking up the most time, the most resources, and we see it here. And when we talk about DNFPBs, BPs, you can see here that there is a real increased risk among some of these types of firms. And it doesn't really matter too much in terms of the shapes of the curves, what type of entity it is, although investment firms and insurance firms do see sort of a higher level of risk in that legal and accounting firm space. But you can see here that DNF BPs, they do deal with that risk, and they do notice that risk of non-banks, that the way that they have to deal with them, there's significantly more amount of work that goes into some of them than goes into others of them. And when you look at specific numbers like, say, real estate services and insurance firms, there isn't too much of an overlap in that Venn diagram between those two businesses. And so, you can see why that's less of a risk. But there is increased risk across all of these types of businesses. Additionally, you can see in 2020, there is a significant increase in the amount of time, pretty much across the board, with maybe the exception of investment firms here, of the amount of time that has to go into all of these due diligence efforts, whether it's transaction monitoring, list filtering, dealing with alerts, sanctions alerts, it doesn't matter. There was an increase across the board. And the reasons for those are the reasons that I just mentioned a little bit earlier, in that the ability to just turn to somebody sitting next to you and ask them questions is massively underrated. Being able to walk over to your manager and say, hey, I have this account, what do you think? I have this alert, what do you think? That all gets lost, and now everything has to be organized as a meeting, which is incredibly more difficult. And so we're seeing those times skyrocketing. This also leads to more concerns about job satisfaction of their compliance staff. And as you know, in APAC, we've had a shortage of compliance professionals for a very long time. And so, this leads to people thinking about the next job. This is something we really need to work on. And I'm going to talk about some of the solutions as we move on in the deck. But this is something we need to work on. Job satisfaction is key to keeping good, trained, smart people in your team to making sure that they are and you are successful. And finally, when we talk about the impact of financial crime compliance on productivity and customer acquisition, unfortunately, by the overall business, it's still seen as sort of a negative impact. And we're going to discuss this a bit later as well. But all of those manual processes, that sort of, the unhappiness, the lack of satisfaction at work, all of those feed into a negative impact on company productivity and on customer acquisition, which is ultimately the goal. When we look at the next key finding, COVID-19, I don't think you'll be surprised at all to hear that COVID was a massive impact on businesses over the course of the past year. You can see here there was year-on-year increases on spending as it was. However, as you see from this orange bit, this is estimated how much more on top of that increased spend companies were spending last year. That if you look at that there, that's nearly a 10% increase for banks over what they were spending the previous year. Same thing for insurance firms, about 5% for investment firms. This is a significant increase because of COVID. But what's really interesting is that this continued COVID spending, it's continued to be expected to increase over the next couple of years. However, the increase that expectation is that there will be a shift to a technology spend rather than a human resources spend, a labor spend. And I think as we saw, everybody went out very quickly and hired a lot of junior people to deal with alert remediation. Now companies are looking at that longer term solution of how do we solve this problem for the longer term? How do we reduce our reliance on manual labor and increase our focus on technology and technology, implementing technology better? Now, we always like to look at the positive side because I think, having worked with compliance departments in the past, having worked in risk management, it's very easy for the business to always just say, oh, you cost me money, you cost me time, you cost me business. My team is so frustrated dealing with you. And it's not totally fair because I think there are a lot of positives that do come out of that financial crime compliance effort. I think first and foremost, I think before we even get to this chart, and I'll leave it up here for you to look at while I speak, but what's really important is that it forces that relationship manager, if you're working in that three-tier strategy, that three-level strategy, it forces that relationship manager, that salesperson in the first instance, to build out their relationship further with their customers so that they are fully comfortable with their customer in the first instance. They know their customer as much as possible, and that they are comfortable with the business that they're bringing into your bank. I think from there, we still see a lot of improvements in a lot of different areas, whether it's risk management, customer relations, understanding your customers better, understanding customer risk tolerances, which is a completely separate compliance issue. But being able to use more data allows for shorter onboarding, better relationships with your customer, and improved risk management. This is a real positive here from everybody's perspective. Finally, I want to talk about those the sort of that split that I discussed at the beginning between technology and labor. And I think that this is really key. This section is essential to our success as an industry and your success as a department and as a business overall, right? Because at the end of the day, your customer as a compliance department isn't the business. Your customer is the end customer. It's the company's customer, so it's everybody's customer. So we need to make sure that we're servicing them best, right? And this is probably the easiest way and the most valuable way to do it, which is to increase reliance on technology. This slide and the next slide are oftentimes, for me, the leadoff for discussing technology and ways to use technology in a bit more in depth than I'm going to go into today. But it's so important to understand the value of technology and the economies of scale that you gain from robotic process automation, from using AI, from using ML, from having systems that speak to each other, from having straight through processing and not having to have an individual involved in every onboarding, every step of the way. If you look at this chart, this slide and the next slide are the two most important slides that I'm going to show you. Very simply, companies that use, and these were all, by the way, all of these companies were similar sized companies in similar business lines. These companies, all of these companies spend less, find more productivity, and spend less time to onboard and maintain customers than customers who spend below the average. So the more you spend on technology, and obviously that spend has to be done efficiently and intelligently, but the more that you spend on technology, the more returns that you get from it. And this is best defined by this next slide right here. We found that the survey respondents who used technology above the average spend saved $50,000 per compliance staff for larger compliance departments. That doesn't mean that they're paying them less. That labor component is still the same. That labor cost is still the same, but they spend so much less because they can do so much more with, on average, 20 more people. They can do so much more that they are spending $55,000 less per person on their compliance program as a whole, because they're using more technology. There is no greater benefit for technology than happier staff, faster processing times, and less spend. It is really the most important thing that you can take away from this true cost of compliance. So just finishing up before we move into the panel discussion. Look, there are going to be increasing risks. We all know this, right? The risks are going to be increasing. The regulatory requirements are going to be increasing. We need to be prepared for this. Skilled compliance professionals continue to be in demand. We cannot meet the demand. We are not churning out enough new compliance professionals to meet the demand of that growing financial crime risk and growing regulatory requirements from our regulators. But companies really should be considering what compliance technologies they're using, what their process is, what their flow is, to be as efficient as possible. A multi-layered solution approach to due diligence and financial crime risk assessment is essential, right? You need to look at every aspect of it, maybe even whiteboard it, put up a blank whiteboard and say, if we could start from scratch today, where would we start? And then go from there and make small changes to your current setup to get to that ideal setup. And then finally, in addition to technology, data. You absolutely have to have data, both good data from your clients, but also good reference data that you're using, because if you're using bad data on either side, that's just going to add to the false positives, and it's just going to add to your manual work that is being created for you, and nobody wants that. Again, I'm Doug Wolfson. Thank you very much for listening. We will have the true cost of compliance, the full survey available, and very excited to hear the opinions of some of the industry practitioners we have today, really for their point of view of the future of financial crime compliance and how they're going to work in what are restrained cost environments. Thank you very much.
Thanks, Doug, for that very insightful presentation. Brent, may I request you to come online as well? Great, excellent, so that we can start the panel. Before we start the panel, Brent and Vaman, do you have any sort of comments on the report that Douglas presented? Any first thoughts on that? Any feedback?
The big one was $12 billion of cost when you look at APAC as a region for AML and KYC compliances. I think the kind of money that people are willing to spend would drastically go down if we are going to have a structured view in terms of all complying agencies working together. Now, I think it's the money is spent disparately by various entities, whether it is banks or by the technology vendors. So I'm saying $12 billion is a lot of money, and if all institutions and FATF comes in to integrate these costs in a meaningful way, I think we can get a far more compliance, risk compliance culture at a lesser cost compared to what we are spending today as banks or financial institutions.
Right. Brent, any thoughts?
I think Dog was actually very much spot on in terms of getting the industry to look at it strategically. As much as we can probably address, short-term requirements by throwing more warm bodies over, into the work, in the long run, we need to look at sustainability. And there you would really see how technology will play a huge role in helping financial institutions and other covered persons from achieving that sustainability insofar as their financial crime compliance program is concerned. And I guess every one of us would definitely be, looking forward to seeing our processes and our controls very much sustainable.
Right, right. Excellent. So let's move on to the panel discussion that we've planned now. And just a note for the participants, if you would like to post any questions, please post them in the Q&A window. We have a fantastic set of speakers today, so do take advantage and ask them questions. Brent, let's start the discussion with you. To begin, what would you say are some of the challenges while screening customers and transactions across alternate channels, including digital? And how are you overcoming them and getting a single view of the customer for the due diligence that you have to do from an AML point of view?
Yeah, good question, Shirish. I think let me start off by saying that at the heart of everything that we do is always the customer. And in fact, Dog did touch on this point earlier during his presentation. So that's definitely one of the key considerations that we have. I'll add three more to it, and those would be the legacy systems and processes. I think every institution will always have their fair share of legacy processes and systems which haven't really been able to keep up with the times. And I think this pandemic has really made that surface quite well, especially for those who've been able to overcome it. Another one will be definitely local screening requirements. We have to admit that across jurisdictions, there are definitely nuances which vary from one jurisdiction to another. So having and bearing that in mind is definitely something that we need to consider. And of course, my last point would be with respect to reducing false positives. That's, I think, what every compliance officer would definitely looking forward to to overcome. Now, within RCBC, how are we overcoming these challenges? Well, first off would be a move towards a digital transformation. So this is something that we were fortunate to have started just around before the pandemic. So much so that when the pandemic struck, RCBC was able to launch even a digital application called Kotak. And through that platform, we've onboarded close to 2 million customers during that 1 year since the pandemic has been around. Another way that we have overcome that is really to work with reliable technology providers and screening solution providers. We've moved aspects of our core banking system into the cloud, and we do engage a very reputable and very reliable technology service provider in terms of providing us our screening solution. And just a last point, last week, RCBC became the very first local banking conglomerate to enter into a public-private partnership with the Anti-Money Laundering Council here. The objective really is to enrich our data so that we can screen our customers and our transactions more effectively and efficiently.
Right, Brent. So congratulations on that first PPP, the public-private partnership that you've signed. Douglas, do you have any comments on, because you deal with multiple banks across multiple jurisdictions,
Yeah,
what would you say are some of the common screening challenges and how are people dealing with them?
It's incredibly valuable what Brent is saying here, and I beg you guys who are listening in and watching us to take heed to this, because the reality is these different legacy systems that people are using, forcing more and more manual work. The people don't want to do manual work. I was in an organization previously, Brent might have even been there at the same time, where we looked regionally in APAC at the 21 or 22 different branches that we had in the region and how they did KYC. And about 15 of them were using the KYC system, 6 of them were using Excel, but saving it on the global drive. And then 1 of them was storing their KYC files in paper format in a filing cabinet locked in their office. Now that does nothing for a regional risk manager, right? For the group head of compliance, he can never access that file, right? And so there's a real need before the US government comes in and says, you must change the way you do business. There's a real need for us to look at how we do business, find those reputable providers and work with them and to develop, that process and using the cloud, using straight-through processing to have an efficient system that hopefully doesn't give you more false positives is the ultimate goal. It saves you time, saves you effort, saves you work.
Right, thanks, Doug. Okay, Vaman, let me get you into the discussion as well. You're a trade expert, so when it comes to trade screening, to start with, can you give us a very quick overview of some salient features of the FATF framework or recommendations or expectations around trade screening? And also, what would you say are some of the on-the-ground challenges in banks, when it comes to screening trade transactions and related compliance matters?
Yeah, I think from a framework perspective, FATF has done a good beginning as far as TBML is concerned. As far as trade screening is concerned, the amount of work that has been done just because of the complexity that is involved in the transactions across geographies and the regulations that are there has been minimal. Now, if you really look at FATF framework for TBML, there was some amount of write-up that happened in 2006 and 2008 and 2012. But more often than not, they have come up with risk indicators. Now, typically, risk indicators need not be the truth. It's a risk indicator. You may have to again go ahead and measure it against the customer that you have with you. Now, what they have done is they have gone ahead and built in risk indicators in the form of structural risk indicators, where they have said, say, for example, a corporate which has got too many layers in terms of its setup, the complexity in terms of the corporate. Then you look at a corporate setting up its registered office in a tax haven or in a location where the AML KYC compliance is weak. So typically they talk of structure of the corporates when it comes to structural risk indicators. Then they talk of trade activity risk indicators. Now, when they say trade activity risk indicators, basically you are looking at whether the customer who has given you the information about what business is doing, is he into that business or he is doing something else? What is the kind of velocity of transactions that the guy is doing? So these are some of the parameters that the FATF wants financial institutions to look at, or the corporates to look at when they're engaging with the other entities. The third aspect, again, when they say risk, they talk about trade transaction risk as such. They also say that, say, for example, if a corporate is using structures to get a buyer's credit, or if they're opening letters of credit to import something which is not required to open, you should be cognizant of the requirements that the customer is asking, and then you should be in a position to look at why he is opening letters of credit or why is he taking a loan. Now, as I said, these are typically risk indicators, and more often than not, when you look at your own customer segment and profile, you find that they are doing legit business. Okay, so one is to look at FATF framework as what you could use to put up your own processes. So, for example, if you look at APAC as a region, a lot of these countries would have a phenomenal amount of restrictions as far as their imports, exports are concerned. So if there are restrictions on imports and exports, if there are restrictions in how you want to do trade finance across border or across borders, then you are taking, ideally you're taking a lot of, you're putting in a lot of controls even to transact. Now, whether to look at AML, KYC, we going through false positives and all is one part of the job, which you obviously do when you're onboarding the customer, you're looking at a beneficial owner. Or when you are getting a customer in, you would want to see whether there are any sanctions against that particular customer when you're onboarding. More often than not, when you're looking at TBML, they talk about cross-border transactions in the FATF space rather than domestic transactions that happen between customers. But as far as banks are concerned, when you're onboarding customers, because there are regulations which are already there to control the kind of transactions you do, you may have to do lesser amount of due diligence on products which are otherwise not controlled. Let me give you an example. When you look at an export transaction, the entire export is controlled. Say, as far as India is concerned, what goods you can export, how much you can export, and the export itself, the goods itself is going through customs. There is a valuation that is done by customs. So essentially what's happening is it's a controlled transaction. Now, let's look at a transaction where somebody is doing an advance remittance for an import. There is no good, there is no valuation from customs. It's just that somebody is giving you an invoice and doing an advance remittance. Now, these are the transactions where you may want to put your own restrictions in terms of processing those transactions. So, for example, while you do a KYC for a customer onboarding, you may want to put a process of doing a trade-based KYC on a customer who is willing to do a cross-border transaction with you. So you would ask him what is the kind of turnover he has on the cross-border transactions, what kind of material is he exporting or importing, what's his turnover, who are the parties from which he is importing, who is the parties from to whom he is exporting. So you could obviously take all those details when you're onboarding a customer. You could do a trade KYC. That is part one. So once you do trade KYC, you can also do filtration on products. The way I said advance remittance, it's a new customer who wants to do advance remittances to customers. After 4 or 5 transactions, you may want to put a filter and ask him, hey, you have done 5 advance remittances. Where is the proof that you have imported the material into the country? So I'm saying as far as APAC and the banks and financial institutions are concerned, they are mostly regulated when they're doing cross-border transactions. Wherever there is no regulation, it is very important for each institutions to put in its own processes like a pattern monitoring, one to many, many to one. So you can put those structures in place to really go ahead and see what kind of transactions your customers are doing. So essentially, while TBML is complex, there are chances of somebody using a weak jurisdiction to remit money out in. You have various examples in terms of how people launder money. But all in all, if you have to really check out and see whether the customer is good, bad, ugly, the KYC of the customer is the foremost thing. I think there is no taking away from doing the KYC on your customer rather than banking on other aspects of where the money is coming from, who are the people who are remitting money. So so KYC of your own customer, your own trade KYC processes that you put, which are in line with what FATF says. For example, some of the risk indicators that FATF says is letters of credit and stuff like that. But my view, in Asian countries, we do a due diligence and set up limits on customers, right? So when you're doing a due diligence on a customer and giving him a line to open a letter of credit or to engage in taking a buyer's credit, you're doing a 3-year assessment on the customer and then taking a call. So the possibility, while there is a risk indicator that somebody could go ahead and use letters of credit for doing a structured transaction, more often than not, as far as Asian countries are concerned, because you do diligence on the customer, do an assessment, that risk is low. It could be there in some of the OECD countries where you may want to do a letter of credit to import coal or a commodity without really looking at the balance sheet of the customer. So it varies from region to region, geography to geography, but it is imperative that banks or financial institutions put their own processes for trade in line with the framework that is being prescribed by FATF.
Right. Thanks. Thanks, Vaman. Brent, coming to the Philippines in particular, what would you say are the regulatory expectations there when it comes to screening? And have the latest 2021 TFS, the Targeted Financial Sanctions Guidelines issued by AMLC, made a significant impact on your current processes? And how is your bank, as well as the rest of the banking industry, dealing with this? Slightly long question.
Yes. But I think let me start off by giving a context in terms of where the Philippines is right now. We're right now in the post-observation period following the fourth round of mutual evaluation review in the Philippines, which occurred back in 2018. So that's the context of the jurisdiction. So the Philippines, to address the comments made by the Asia Pacific Group, have legislated an amendment to our Anti-Money Laundering Act back in January, and largely to address technical compliance in terms of where we should be in comparison to the requirements under the FATF. And so far as screening is concerned, the Philippines largely has, looked at it as a, customer screening requirement. That has been the case for most of the time until this new law came into place, which now changed or rather enabled the focus to evolve to include that of transaction screening as well. So that's where the challenge lies, because for quite a while, the domestic players here, the covered persons here, have largely been focusing really on customer screening as part of our financial crime controls. But now with the new, with the revised law, it now, enlarge the scope to also look into the things that Vaman were mentioning earlier, such as dual-use goods, vessels, and those entities that may be involved in the proliferation, financing, or weapons of mass destruction. Those are some things that you might not necessarily immediately find out when you do the customer onboarding, but at the transactional level, that's where the challenge lies, because now we have to do more in terms of screening our payments, our trade finance transactions, most especially. So that would be an area of challenge for the Philippines, where trade finance, as similar to the other markets within the region, are still very much largely paper-based. So making that connection and transition from being a very manual, very paper-based process towards a system-oriented or technology-oriented process is a huge challenge for the local players here. And as a result of the change in the law, we've started to engage as well our screening solution provider to see where they can come in to help us. Insofar as our bank is concerned, RCBC looks at automated solution as the solution. And not to throw more warm bodies in there to do screening and to discount alerts as the case may be. That will be definitely the option of last resort. So we definitely are looking forward to enabling technology to help us comply. with the requirements of the new law and the foregoing regulations that come with it.
Right. Thanks, Brent. Vaman, speaking about sanctions, how do you ensure that the trade operations in the bank are well protected from potential sanctions breaches? Are there any good practices that you would like to share in this area?
Okay. Shirish, I think this is one question which is of an interest to me. Basically, because if you look at the SWIFT transfers that you do across the globe, you do remittances in dollars to various countries. You have your correspondent banking relationship with the American banks. But just look at the kind of information that each bank would share when they're doing the remittance, whether it's an outward remittance or an inward that is coming in. What's the data that we're sharing? The data that we're sharing is typically the account number of the beneficiary, the name of the beneficiary, and then the amount that you're sending. There's no other information that goes in an empty 103 or a 202. There is no description that is being given. So while people say, while we are all saying that there is a lot of monitoring that happens, even with the best of the solutions that you have, you are only looking at the beneficiary name and the account number for screening. Now, then the next question is, how is it that you would want to screen the transactions? Now, you see the kind of responsibility that we are putting on banks. Banks could be weak, banks could be strong, banks are in weaker geographies, banks could be in the best of geographies, but look at the spectrum of banks and the countries that are involved when you're looking at screening process. The screening process itself is a question mark as far as trade is concerned, because you don't have any meaningful information and it is left to individual entities, isn't it? It's left to the individual entity. If there is a weak bank, if it is not checking the documents, it's not checking the documents. There's no way you can go ahead and catch that particular bank or a customer. So typically, I think what, as far as we are concerned, the way I told you, one is that we do trade KYC for the customer. We have actually risk-based analysis on each product that we do. So for example, export, import, where you have a third-party confirmation, which is customs, you may be checking the buyer or a seller, but when it comes to advance remittances and where you are actually some of the customers getting advance remittances for exports, you have a separate monitoring system. So if you get 5 advance remittances, there is no export that is done. Or if you have done 5 import advance remittances and there is no import that has happened, then we go ahead and question the customer. We do an additional due diligence on him as far as trade is concerned. The third aspect is most of the customers to whom we are giving limits, we do an assessment of the customer on the onboarding KYC. So these are the steps that we do. We also have an integrated platform with the trade system that we use. So as and when you punch the details of the beneficiary or the commodity, it gives you a alert if there is a problem with either the commodity or with the name of the customer. As far as India is concerned, dual use goods is taken care because of the regulation itself. There is something called SCOMET. So there is an approval that you have to take when you're doing export of dual use goods, and it has got a very stringent process. So as far as India is concerned, on the macro level, we are sorted in the sense that, for example, the export electronic document that which is given by the customs, or the import electronic document that is given by the customs, is all there. Hitherto, what used to happen is somebody would have exported, unless he gives the document to the bank, we would not know that he has exported. Similarly on import. Now what has happened, they have integrated customs and the Reserve Bank of India, they have integrated on a platform where all these documents which are ascertained by the customs are available on the net electronically. So basically, if you look at the macro side of the story, as far as India is concerned, a lot of these things are taken care of. Dual use goods through SCOMET, the electronic, the custom documents available. Then you have KYC, which is a framework which everybody follows in the bank. So all those macro things are taken care. On the micro, at a transaction level, we have system integration, which would help us. But having said that, is it possible for all the small banks to go ahead and buy a platform and then a screen is a big question mark. Now, it's also a function of the geography and the rules that are playing there. Suppose if you have got a gray list country, you can now imagine what happens to the banks that are there in a gray list country, right? So my thought, and I have always been advocating that entities like LexisNexis should have a discussion with SWIFT. SWIFT is a platform which all global banks use. That is the only network which is used for transfer of funds. If you can add 3 fields: port of loading, port of discharge, commodity. Commodity comes out through ITCHS classification. If you have these 3 fields in SWIFT, and you are putting that data into the transaction whenever you are doing a transaction, that information is available at a global level. That information is available at a geography level to the FIUs. They can do maximum amount of due diligence as far as trade transactions are concerned. You don't have to buy a system because for somebody like Doug, per transaction cost is what it is, and almost everybody would pay, right? Because if I am putting the data, if Lexis screening system is integrated with SWIFT, and SWIFT has got these 3 fields, and the data is flowing. Suppose if you're doing a remittance to a country or a destination which is otherwise sanctioned, automatically the alert goes to the FIUs. Why should it be that banks or institutions should collate data, give it to FIUs then sit and look at it? The data is available. Technology, as Doug said, is the most important thing. We are in an era where everything can be centralized. The second point that Brent said is the knowledge levels of people, the compliance officers, the people who have got the ability to look at trade-based transactions. You can have a centralized kind of a wing within FATF and then look at all these kinds of data that is getting flown instead of relying on weak banks, weak geographies to get the right information.
Thanks, Vaman. So Douglas, some pointers for you there. I'm not sure if you want to respond to that now.
I'm not sure, Vaman, if you would like my if you'd like my job. We can certainly discuss a trade. It's a very interesting point. It absolutely is. I think it creates a significant risk shift of risk ownership away from the banks, which is obviously very interesting for the banks, and onto the providers. And so that's not the regulatory framework that we currently live in. I don't think it's the regulatory framework that our regional individual regulators have envisaged, or the FIUs. And so, it's not the current world that we're in. I think it is very interesting. It's something that we've discussed previously.
The only point I have, I'll tell you, the only point I have is even if it is country specific, right? The data which is there between SWIFT and the screening systems can go to FIUs directly without they asking us data. So for example, they are now relying on all the banks to give information. A weak bank without any process, what information would it give? So I'm saying you are actually disintermediating the banks. You are getting what data you want within the country that you are residing. You don't have to have, obviously I agree with you, there will be a lot of constraints in terms of sharing data globally across the world. But within the country, within each FIU, you can have massive information going. And the other big thing is what? The other big thing is one side you have criminals, the other side you have got law enforcement agencies. Both are equipped to deal with each other. In between, yes, we are there and we don't have so much of information on what these guys are up to.
Yeah. So I think you make a very good point, which is, water sinks to its level, right? Criminals are always going to look for the weakest link in the chain to break through. There's no question about that. And I think there's a need for every bank to be able to deliver a minimum level of information. Now, obviously, there's more to that transaction than just the names, the numbers, whether the port of embarkation, port of debarkation.
Yeah.
There's all the information in the KYC file as well. There's the investigations that the banks themselves have undertaken before passing over the information to the FIU, which I think obviously, entities like SWIFT ourselves would have no concept of what that information is. So
Yeah.
I think that there is definitely room for potentially more collaboration, but I don't think we're in a space, I unfortunately have to disagree. I don't think we're in a space that adding 3 fields to the SWIFT transaction to the MT-103 solves everybody's problems. As much as we'd love to.
That's why I said we'll have to.
Great. So let's agree to disagree on a couple of points.
So then we go back to the basics, right? Like you do your own trade KYC, you do your own assessment of the client, and then go ahead with it.
Yeah, I think what may work is a hybrid model, right? Where data is coming from SWIFT to the FIUs and also supplemented by, as Doug said, data from the banks, their own case papers, their STR filings or whatever it is.
Yeah.
And that is put together and then everything is seen in context, right?
I think if I may just add, the reality that I'm seeing across the different jurisdictions where I have had the pleasure of working in is that the government, our regulators are not in a position to be able to really do a lot of the heavy lifting from their end. And there is a recognition that the collaboration between them and the covered institutions or the covered persons, is a critical component towards achieving what we are all looking for, which is being able to fight financial crime. And so that kind of dependence, I think, really shifts the burden or the onus towards the private the institutions to ramp up their systems in order to be able to provide meaningful information to the regulators or to the FIU. So it's an ideal scenario, but the reality is across the different markets where at least I have been exposed to is that there is also a short or a limitation in terms of up to how much can the government or the regulators actually do from their end.
Right. Thanks, Brent. Brent, Doug, and Vaman, thank you so much for joining us today and sharing your thoughts. We look forward to having you again at future sessions.
Thank you. Our pleasure, Shirish. Thank you.
Thank you, and my pleasure.
Thank you, Shirish, and happy to. I know we didn't get to a couple of the questions, so we will be happy to respond to those, and we can reach out by email after this event.
Absolutely. So participants, thank you so much for joining us today. I trust the session has been useful. As Doug mentioned, we will attempt to get some of the questions answered offline and share the responses with you later. To view more sessions and videos like this, please do visit fintelekt.academy, which many of you know is our new learning platform. It's just a free registration, but you can keep learning. My sincere thanks again to the Asian Bankers Association for partnering with Fintelekt for this webinar, and we look forward to the next one again in the first week of May. So everyone have a great day and see you again soon.